Okay, let's dive into this. Welcome to today's Explainer, where we're going to unpack some of the wild, honestly, kind of mind-bending contradictions currently unraveling in high finance. Specifically, we're asking the big question: why exactly are private equity markets secretly struggling behind the scenes?
So here's the central mystery we're looking at today. It's a classic facade versus reality situation. On the surface, private equity publicly reported a whopping $717 billion in exits for 2025. Supposedly, their second best year ever. But the reality? Well, investor payouts have actually slowed to multi-decade lows. We're talking levels we literally haven't seen since the 2008 global financial crisis. So how exactly does an industry report a booming year for exits while simultaneously starving its own investors of cash?
Section 1. The Private Equity Paradox. Unpacking the contradictions of a booming and busting market.
Right, so beneath those massive headline-grabbing numbers, structural breakdowns and historic losses are quietly taking place. To really get this paradox, just think back to the baseline model. You know the drill. A firm raises capital, buys and theoretically improves companies, flips them for a profit, and distributes those returns. I mean, that's the ideal scenario anyway. But here's the reality check, brilliantly captured by one massive number: 32,000. Instead of successfully flipping these companies, the number of unsold assets stranded in private equity portfolios has absolutely ballooned to over 32,000. They are literally stuck holding the bag on all these acquisitions.
Section 2. Behind the exit illusion. How a few outliers mask a shrinking industry.
Okay, so if over 32,000 companies remain unsold, what on earth drove those record exits? Well, the fine print tells a wildly different story. That $717 billion looks amazing until you dig in. Deal count actually fell 6% down to just 3,118 total exits. So how did the overall dollar amount go up? Simple. The average deal size skyrocketed to a record $1.2 billion, and crucially, just 13 individual sales accounted for nearly a third of all transactions. The industry is actually shrinking when it comes to deal volume.
Here's a perfect example of one of those mega deals: the $55 billion Electronic Arts take private. This wasn't a bunch of small businesses being flipped. No, this was a massive outlier transaction led by a sovereign wealth fund, buying a video game giant with some private equity partners just tagging along. These massive outlier transactions artificially inflated the averages, completely masking the fact that traditional middle market buyouts, the local chains, the plumbing companies, were struggling to find buyers at all.
Section 3. The shell game unveiled. Hiding the lack of buyers. So what actually happens when they can't find legitimate outside buyers in a frozen market? They financially engineer their way out. Despite the supposed exit volume we just talked about, actual distributions back to investors stayed completely flat at 14% of net asset value. And wow, that perfectly matches the deepest lows of the 2008 and 2009 financial crisis. They're reporting huge exit values, but they're barely paying anyone back.
So where exactly is the money going? Well, it's going into continuation vehicles. Essentially, a private equity fund sells a portfolio company to a brand new fund managed by the exact same firm. It's basically a shell game. Funds are selling companies to themselves just to extend the clock, satisfy their expiring fund timelines, and pretend everything is totally fine without having to actually realize their returns on the open market.
To put that into perspective, in 2025, secondary transactions hit a record $226 billion, but a staggering $115 billion of that, so over half, came from continuation vehicles alone. Let that sink in. Over half of these record secondary market exits were just funds trading assets internally to delay realizing losses. It inflates the exit numbers and the acquisition numbers simultaneously. Wild, right?
Section 4. A gated private market. The death of local buyouts and the rise of mega funds.
This brings us to a major shift in the core identity of private equity. The struggling old model of flipping local businesses, your traditional leveraged buyouts of dentists and regional chains, that's rapidly shrinking. Against that, we have the new reality: the rapid growth of mega-cap take-privates. Private equity is basically becoming a conservative, gated stock market for mega-cap companies that only the ultra-wealthy and institutional investors can even access.
Let's look at the broader data on how wealth is shifting. The top 10% of households now own about 87% of the public stock market, which, interestingly, is actually a slight drop from previous years. But wealthy groups are simply pivoting over to these exclusive private markets. The result? When you include gated private markets, Overall, financial assets are more concentrated at the top than ever before. The most stable, lucrative assets are increasingly locked away behind gated private arenas, completely out of reach for everyday retail investors.
Section 5. The software valuation apocalypse, when artificial intelligence meets high-interest debt. All right, we've arrived at the climax of our explainer. Two twin external catalysts are currently collapsing the most highly leveraged strategies in this market. First up, the debt. Private equity buyouts over the last decade were heavily fueled by cheap debt from private credit, often packaged into CLOs or collateralized loan obligations. But major cracks are forming. Just recently, a junior CLO tranche managed by Bain Capital defaulted for the first time since the global financial crisis. Furthermore, in early 2026, 5 of the 6 major private credit funds actually gated investor withdrawals to stop the equivalent of a run on the bank. Basically, liquidity is severely drying up. Which triggers the second catalyst, the software as a service, or SaaS, collapse. We're seeing a massive drop in median public SaaS revenue multiples, plunging from 6.2x at the end of 2024 to just 3.3x by March 2026. That represents a totally devastating collapse in software valuations. It wiped out roughly $1 trillion in market capitalization in just one single quarter.
Now, you might be wondering, why is this happening? It comes down to this number, 80%. A staggering 80% of private equity buyers now view AI-driven commoditization as the absolute biggest risk to their software portfolios. Companies literally believe they can use AI to just code workable alternatives to the expense of enterprise software they've been subscribing to. That belief alone is shattering the very foundations of these valuations.
Let's ground all this macroeconomic data in a real-world story. Thoma Bravo, a massive private equity firm, recently surrendered the $5 billion software company Medallia to its lenders. This cements one of the largest wipeouts in the history of the industry. Medallia makes software to track consumer feedback. It was, and honestly still is, a profitable business, but it was fundamentally crushed by the adjustable rate debt piled onto it by its private equity owners just to make the acquisition in the first place.
When the value of the company dropped and the debt payments skyrocketed, the firm just walked away. Just listen to this remarkable confession from Orlando Bravo himself. We underwrote really fast growth, and in hindsight, we paid too much because that growth didn't materialize. This perfectly verifies the reality that funds wildly overpaid during the cheap money era and are now paying the ultimate price.
So what does this all mean? The crucial point is this: when we strip away the facade one last time, we see structural failures across the board. The record exits of 2025 were heavily masked by self-dealing continuation vehicles and sovereign wealth outliers. Actual cash investor distributions remain stuck at 2008 lows. Private credit liquidity is severely drying up, and AI innovation is absolutely shattering foundational software valuations, completely exposing the highly leveraged, high-priced deals made over the last decade.
Which leaves us with this final burning question. Is this just a temporary market shift, or the beginning of the end for the traditional leveraged buyout model? Think about those 32,000 stranded companies. Think about the mountain of debt. It's a fascinating and honestly precarious time in high finance. Thank you so much for joining me for this explainer. Keep asking questions and always keep looking closely at the numbers behind the headlines.